And welcome everybody. So nice to have you here today for our All Things Fun and Credit. So we are recording this, so if you're seeing this live, welcome, and if you're seeing it recorded, well, welcome too. But obviously those that are here live with us can ask questions, so feel free to, as we go through, pop any questions in the chat, and if not, we will dive into all things credit. So Ken, welcome. Ken is credit guru, so maybe you can just give me a little bit of background on yourself and how long you've been doing all these fun things with credit.
Well, good. Thanks so much for allowing me to be part of this. I always get excited sharing my passion. And that's what it is. It's a passion that I fell into about 11, 12 years ago. I got involved, I always was involved in business finance, and I've always had a keen interest in helping people out, and these two things kind of married together. And so about 11, 12 years ago, I got involved in credit, and basically it morphed from me working to someone to me eventually buying out my company, and we work across the entire United States, but primarily I work with loan officers and realtors.
Awesome. Ken, your audio is rather quiet. I just checked; it's also quiet for the audience too. So I don't know if you can help us.
Well, I will move closer to that.
That helps.
Better?
That helps. Super. Thank you.
Good.
All right. So when I'm working as a loan officer with clients, one of the things that we look at is credit, obviously credit. And there's two different things that I pay attention to, which is credit depth and credit score. So I'd like to go into that a little bit and have you speak to those two things. But then let's start with what's different about a mortgage. So a mortgage credit score is very different. I so oftentimes have people say, oh, I got my Credit Karma, or I went to get a car and my credit score is 802 or something. And then I pull it and it's actually 730. So can you speak to the distinction there with a mortgage credit report?
Yeah, that's probably the biggest question or confusion that I deal with. And basically, credit is big business. It starts off with the credit bureaus. Now, the credit bureaus are gatherers of information. They have all kinds of little subset companies that gather things about you buying cars, leasing cars, opening up credit cards, even paying rent, anything to do with some type of responsible financial transaction. Generally, the credit bureaus will have that information. Then there are entities, companies that create scoring algorithms. It's called a risk-based score, which is basically if someone is going to attempt to approve you for a car loan, they want to know how likely they are or you are to fulfill that requirement. So they generate a scoring algorithm that looks at a bunch of different data points that they get from the credit bureaus, and they come up with a score generally between 300 and 800 that determines how likely you are to default. Now, in that scoring algorithm, there are literally, hundreds of different models. For example, Credit Karma, Credit Sesame, generally any credit score that you and I as consumers have access to. These are generally referred to as consumer-based scores. They almost all use a scoring model called Vantage, which is a very, very popular score model. Now, the difference with that, if you go to Credit Karma or Credit Sesame or one of the consumer sites, you typically will see a score that could be pretty nice, pretty high in the 700s. Now, what happens when someone goes to buy a car or to, especially in your industry, Nikki, the mortgage, they pull a mortgage report, which uses a much harsher scoring algorithm. It's the official FICO scoring models. It looks at information from the past 7 years, and it's very critical of any negatives in a 2-year period. So almost always, not always, but mostly, if someone has a 700 credit karma, they may only have a 660 or maybe 670 mortgage score, FICO score. So yeah, we as consumers really don't have access to the official scores.
Yeah, got you. Yeah, that's a good one. It's always a confusion with people. It's a residential mortgage credit report. I always say that, you're asking to borrow hundreds of thousands of dollars from me, whereas when you're buying, a credit card or a car, you're talking and maybe up to maybe 50 or 60 at the most. But we're a little more picky in our industry. We want to make sure that you can pay us back. So let's see. When I'm working with a customer, I have this sort of rule of 3 trade lines, and maybe you can talk about trade lines and what builds a good credit score. We in the lending industry really want to see history, want to see that you have a depth of credit that you've built over time. So we'd like to see 2 years history. We'd like to see 3 trade lines that are at least 2 years old, and we like to see that they've been active in the last 12 months. So that's my rule. But talk to us about what a different trade line is, and does a credit card affect your score differently from a car loan, so to speak?
Great. Yeah, so basically you hit the nail right on the head, and around 3 active trade lines is very good. The credit formula likes a variety, meaning it likes to see revolving credit, which is credit cards. If there was an auto loan, that would be a student, or that would be an installment loan, and that's good. If you had a student loan, that's also installment loan. And then naturally, if you have a mortgage, that is good as well. But the foundation, I call it, is usually your credit cards, because a car loan will eventually end. Hopefully, student loans will eventually end. But a credit card, if you got a credit card at 20 and you're in your 30s or 40s, it really ages out. And the credit formula loves revolving credit that is older than 10 years. So I always coach people, especially if you're talking to your children, start them off on credit early. Teach them, not to spend naturally over what they have, but to keep those cards active and growing. And yeah, you hit the nail on the head. About 3 credit cards is what you need.
Yeah, when you talk about keeping them active and growing and not spending more than you have, that's the key, is to use the card. We want you to use them. We want to show that you know how to manage debt, but you can pay it off. So as long as you use it and pay it off, put a tank of gas, pair of socks, each month pay it off, then we're happy. Talk to us about if you do make a choice to hold a balance. So sometimes people, for whatever reason, say, this is worth it to me to hold a balance for a while, even though the rate might not be good, the cost of funds might not be good. From a credit scoring perspective, at what level does it really affect their score if they're carrying a balance in terms of the percentage of debt that's used?
Yeah, very good. So you're right. You want to keep, ideally, we coach to stay below 30% of the credit limit. And that's because people are generally using their cards. I mean, there is some people that do not like credit cards, but they understand the value in their credit scores. So typically, all you really need to do is use the cards at least one time every 6 months. If you don't use it for 6 months, the credit formula kind of ignores it or bypasses it. So technically, In a perfect world, if you're not using your cards, use them at least once every 3 to 5 months. If you're using them actively, then attempt to stay below 30% of the credit limit. Lower is even better for your score. Sometimes if people have everything come out of their credit cards and they pay it off at the end of the month, well, I might coach them to, rather than pay once a month, pay weekly or bi-weekly. That way they can use the cards for their own benefit. But then at any time, the reported balance would be smaller and have a higher credit score.
What you just said there is so fundamental too, in that at any time. So your credit score is not, it only matters when you're pulling it. It doesn't matter if for some reason you're carrying a balance 100% of the credit limit today. Unless you're pulling credit for a mortgage or something else, as soon as you pay it off, your credit gets healed, correct? Or the score will then change.
Yeah, it's a snapshot in time, and the creditors only really report once a month. So many times people will say, well, no, I don't owe 3,000. I paid that off last week. Well, you may have missed the reporting cycle. And basically what I tell people is that if you pay, today, the 22nd, it might take 30 days to reflect on the report as a paid balance.
Mm-hmm. Little side note on that, in the lending industry, if we see that and we need the balance to be at zero, we can do a rescore. So we call it a rapid rescore, where we go in and we show the current balance mid-cycle, as Ken said, and we say, hey, hang on a second, the count is now, and we get it rescored for our purposes. Not all mortgages allow that, but many do. So just as a side note, there are options. But so if you know you're going to go buy a house in the future, don't stress about the balances so much until you're about 30 days away, and then get them paid down. That is a key. At one point, Ken, they talked about looking back further versus just the instant snapshot in time. They talked about taking into account more of our credit patterns. Do you see that changing?
Well, I think you're referring to what's called trended credit, which remember, this credit business is big business. They're constantly coming up with new formulas. A couple of years ago, we heard in the news that they were not going to factor in medical collections. And the credit bureaus give us all this updated news because they are creating better and better scoring algorithms, looking at alternative credit, trended credit over a period of time. What's really important is to realize that most mortgages use what's called FICO 8. So there's a FICO 9 and a FICO 10 out, but the mortgage companies, Fannie Mae, Freddie Mac, for them to retool to a new scoring update is massive, and almost all have not done it. They haven't done the 10, they haven't done the 9. So all these things we hear about that are improvements really are not impacting us because we're using a outdated scoring model.
Gotcha. I think one of the keys you said, this is big business, and it is. There's a lot of people who are incented to or have opinions on how this should go outside of just us little old consumers. So one of the other things that you touched on there was medical collections, and those are the ones that I see go to collections so flippin' fast. A number of times that I pulled up a credit score and we have a $50 copay or $150 medical bill that somebody had not noticed that they have on there, and it's now showing as a collection. So I do recall that something changed recently where those can be removed. Can you talk about collections? Like when you get one, what happens there?
Yeah, so specifically on medical collections, there was an update through the government, and generally there's an oversight called the Consumer Financial Protection Bureau. And in the past, you could go to the doctor. They said you owe 50 bucks. You didn't pay it because you thought your insurance was going to pay it. And lo and behold, 30 to 45 days later, you're called by a collection company. That was pretty prevalent for many, many years in the past. About a year and a half ago, the CFPB put a restriction in that any medical collection cannot go to collections, or any medical charges can't go to a collection agency for 6 months. That gives us, the consumers, time to navigate through the insurance and all that stuff. Now, collections in general, any collection on a report is what I call a red flag. It's very serious. Now, there is a hierarchy of, a collection for a credit card is more serious than a medical collection, but when it really comes down to it, a collection is devastating to a credit report. And if the collection is under 2 years old, generally satisfying that collection will result in a score increase. If the collection is older than 2 years, say it's 3 or 4 years old, and you pay it, not always, but in a great majority of cases, the act of paying an older collection can actually lower your credit score. So generally, my company, we can advise on that.
Yeah, that's something that we'll see sometimes whenever, I have a collection. Because it's a judgment against you, we actually have to have those cured before closing on most mortgages, but many times we'll say, don't pay it yet. Let's wait, because we don't want your score to actually go down due to the process. And let's say it takes you longer than the credit report is alive to find a house, or valid to find a house, and we have to re-pull it, and then you've paid that collection, you actually could hurt it. So sometimes we'll have those things paid through escrow. So do make sure to talk to us before if you see a collection, before you pay it. One other note that I had a client, and you helped me with, was where they had been given notification of collection in the mail. They freaked out, and we called you, and you said, well, make sure to ask from the collection agency, has this reported yet on credit? And that was such an important distinction, because it's not automatic, apparently, that when you receive a notification that you've been sent to collection, that they've actually told the credit agencies yet. So tell us about that. Is there any certain time frame that they usually wait to actually report to credit?
Yeah, so an original creditor, if you default with them, there is a period of time that they sell that to a collection company. I kind of call them piranhas. And these companies buy defaulted debt, and then they go through their process of attempting to collect. Now, in most cases, if a collection company sends you a letter or calls you, and this is the first time you've heard from them, they most likely are trying to get your attention. And it may not have even reported yet to the credit bureaus. So if the collection is valid, you know about it, then and it's recent, then it would probably be a good idea to consider paying it. But that's only if you know if they haven't reported it. So how do you check? Well, you go through a site to pull your credit. You can contact me, we can check. Or you can ask them directly, have you posted this to the credit bureaus? And they'll generally tell you, no, we have not. You have until X period of time to do that. So does that answer your question?
Yeah, it does. And it's such an important point, because so many times I'll work with people and they're fighting a $50 thing because Comcast told them that they had moved out and they should have paid. And honestly, as much as I hate to say this, for the sake of the $50, pay it and argue it afterwards. And you'll probably may not even be able to argue it afterwards. But so many times I see people looking to buy, $1 million homes where their credit's hurt by a $50 Comcast or whatever. I'm just picking on them, but it's not worth the stress and the hassle of dealing with the aftermath of having to go down and figure out, was it your fault, was it their fault? As much as that's probably not right in the big scheme of the world, it's sometimes I just say, just pay it. I wish you'd paid it, because they, to just try and prove that you're right, you hurt yourself in the long run. So we have about 7 minutes left. If anybody has any questions, please do feel free to pop those in the chat for me. But can you and I talked about the top 3 tips of how to repair your credit? So can you sort of give us a high level? I mean, I know for me, the best way to repair your credit is for me to call Ken. So you're an expert at it. And so, having my clients work with you is a great way to know that they're going to be well taken care of. But can you give us some just tips?
Well, as far as tips, I think probably the first thing I would always advise someone is to stay on top of your credit. I have great sites that I recommend that monitor your credit. They give you updates. They'll alert you if there's a problem, and you can get a fresh updated report every month. That's the first step. I call that being proactive. As far as tips to protect your credit, I guess I just go back to monitor your credit, stay on top of it. That's the best advice I can give.
I do note that on some of your credit cards, you can actually go in and add a service to just at least see where your score is. So that's the only thing just to note, is many times that's only with one bureau. So if you have a B of A, for example, it might be TransUnion, and there are 3 bureaus. Can just give us a quick, the 3 bureaus and are the websites that you use, if you could maybe mention a couple of them, do they allow you to check all 3? Because you may have one credit card report you late to 2 of the 8 bureaus, but not the 3. So just give us a bureau 101 quickly.
Okay, so yeah, there are 3 credit bureaus: Equifax, Experian, and TransUnion. And creditors, they have to pay to report to a bureau. It's only like 25 cents every month, but if you magnify that times the amount of clientele they have, it's big money. So many times, someone will report only to Experian or only to Equifax. Bigger entities typically report to all 3. Now, if you use something like Credit Karma, you are seeing 2 credit bureaus. There's one other one. You can go to annualcreditreport.com, but that's kind of a labor-intensive thing, and in the past you could only get 1 report a year. I think they've actually loosened that up because of the pandemic. But
just as a note, annualcreditreport.com is the free one that is available to everybody, so that you don't have to pay to see what your credit score is. I don't think it's a governmental agency, quasi-governmental agency, but it's a regulated group that allow you to see. But as Ken said, it's kind of not good enough, but it's out there. That's annualcreditreport.com. A lot of people confuse that with freecreditreport.com, which is not the same, right?
Exactly. So yeah, and you have to remember that all of these consumer sites are businesses, and they want to advertise for you to get credit cards through them, car loans, and even mortgages. So if people have my contact information, I have a discounted service I use that I would be free to share, that I highly recommend as well.
Perfect. Well, when we post this online, we'll make sure your contact information is in there and be able to share that. So thank you for that. We do have a question about soft pull versus a hard pull. What is the impact on credit? Could you talk to that?
Very good. So yeah, a soft pull is when you check your credit, or an existing relationship checks your credit. For example, say you have a Chase card, and in their routine business practices, they check your credit. That is a soft pull. Those don't impact your score. What does impact your score is hard inquiries. categories. And that's when you are actively looking. You're going to buy a car, you're going to buy a mortgage, you're going to open up a credit card. So when you're pursuing financing on something and you have that entity check your credit, that is a hard pull and that will affect your score.
Yeah. And sometimes it's a good thing to get a hard pull. That is, when you come to me and people often say, well, I want to get pre-approved for a mortgage, but don't want to check my credit. Well, that's sort of like giving me half of the information so I can give you a half of a diagnosis. So we really do want to pull it. It's think about 3 points, right? A hard pull is about 3 points-ish on the credit score. Is that right, Ken?
I think that's a very fair statement. And remember that a hard pull is going to only impact your score for 90 days. So it is a small hit and it does lose its impact in 90 days.
And just as another note, let's just say you talk to 5 different car places. You say, I might buy this car, that car, another, and you do 5 hard pulls. My understanding is as long as those 5 were within 30 days, that counts as 1 pull, correct?
You are correct.
Oh, you were shaking your head. I'm like, please tell me I'm correct. I've been telling. Yep. Okay, good. Yes. So if you know your score is fairly good, a hard pull is no big deal. It's a good thing. Just, if you're looking to, especially for mortgages, we want to look at depth. We're not just looking at scores. We look at the amount of debt you've had and the credit utilization. So we go into more detail. So even though you say, hey, I have a 800 credit score, if you only have 1 credit card, it is actually going to limit you. If your depth is just that, it's going to limit the type of loans you can get in the jumbo market. Those are the larger loans. The conforming market, not so much. Those are the smaller loans, but just know that there is a good reason to pull credit and it's not that big of a deal. If your credit score is 660 and we can't afford to lose those 3 points, then it could be a big deal. So again, that's something to talk to your lender. Just real quick, Ken, tell us a little bit about repairing credit. How long does it typically take? What's the sort of a project in credit repair? And, what's the biggest swings you've seen in credit scores? I know I've personally seen people's scores jump 100 points with one credit item that we get repaired. So can you just give us a overview on what you see there?
Yeah, so there, depending on once we review a credit report, we can be pretty accurate on saying cause and effect, meaning, you do this, this is what your score will be. And when we're looking at damage, whether it be something that is 3 or 4 years old, in our process of removing damage, we typically, our average client sees about a 40 to 50 point score increase. Yeah, I mean, there's times we received 100, 140, and a lot of companies taunt big successes, and but in reality, we can give a good estimate on what the cause and effect would be of removing certain items.
Yeah, that's brilliant. We also do have a thing called we do a simulation. So if you have an active credit report with your lender within 30 days of us pulling that report, we can do a simulation. If we did this, what would the score do? If we did that, what would the score do? And that's a great way for us to say, yes, it's worth going to get Ken to help you do all of that, because it's going to increase your score to a point that you can get a mortgage and have no issues. So Ken, thank you so much for joining us. We are going to call that a wrap. I think we've answered most of the high level questions, and look forward to putting this out. And if you have any questions, if you're watching this as a recording, we will add Ken's information and my information, so you can always reach out to us. So Ken, thanks for joining me.
Thank you very much. My pleasure.